Hello and welcome to UTI Mutual Fund presents Swatantra, an investor education initiative powered by ET Now, that we're doing today exclusively for FICCI FLO and YFLO members at the FICCI headquarters right here in New Delhi. And with that, I'm going to introduce my esteemed panelists. These four ladies present right here. Hina Nagpal, she's the Managing Director at Quantum Leap Wealth Advisors. Rajal Kothari, partner at Capital League and All Women League. Rita Gupta, Chief Finance Officer at HCL Avatars. And Ritu Mathur, Director at Megriar Advisors Private Limited. We're going to focus today on personal finance for working women, as all of you already are. So I'm going to start this interactive session here today with the lady on my right, Hina. Hina, firstly, why should women look after their own personal wealth?
I wouldn't say that women need to look after their own personal wealth. Between your husband, you, or whoever else is apt at it, you can very well, give him the guard. But my question to you is that every well-running company has a second in command, right? Who's just as clued in as the first in command to take over. Your house is a company. Do you have a second in command should something happen to the first in command to take over without any hitches and carry on? And point number two, finances are very important in every marriage, in every household. You all are intelligent women. Why shouldn't you be a part of it? There are angles that you can see, perhaps your husband can't see. You'll only value add. So I think it's very important for each one of us to be involved in what we are doing.
Ritu, I'm going to come to you next. Let's start with the basics here. I'm sure a lot of people are wondering, what is a mutual fund? A lot of us believe that mutual funds are market related. If they are, explain to our audiences what exactly is a mutual fund and why should one look at a mutual fund as opposed to other asset classes like gold or real estate, which all of us traditionally have been brought up with. Save money, you have excess amount, put it into real estate. If you have a smaller amount, buy a gold coin every month and accumulate money.
Well, actually, whether it's real estate or a gold coin, all of that can be done through mutual funds.
Exactly.
So mutual funds essentially, I think, is a fairly misunderstood, if I may use that word, a subject or an asset. It's not really an asset class, it's a vehicle. It's a vehicle which gives you access to any asset class that you may want to access. So whether it is equity, whether it is bonds, whether it is gold, whether it is real estate, there are options available within the mutual fund industry which can give you access to any of these investment avenues. So it's really misunderstood in a way that mutual funds means equity, means stock markets, means risks. There is a broad spectrum of mutual funds and a broad spectrum of risks and assets that are, that it can adhere to.
So I'm going to come to you, Rajal. Yeah. How does one begin investing in mutual funds?
The simplest way to make a beginning is that you would all have some balances in your savings account which are just lying there. So to experience that what a mutual fund is, you could probably start investing in a very, very simple basic scheme, which is a liquid fund, which is like a, let's say, negligible risk product, which will only give you a small return, but it is fairly safe. So it is not that even if you start with a 5,000 rupees, you know that even if you do not lose it in a liquid fund, but even if tomorrow you don't have it, you don't miss it. So that gives you the initial confidence. The second thing is that when you're looking at long-term investments, then you could want to start investing in some long-term instruments which are available or long-term asset classes which are available through the mutual fund. So it could be a combination of equity, debt, like Ritu mentioned. So the best thing, again, if you wish to start on your own, is that you look at a good diversified mutual fund, a good diversified equity fund, which has at least a 10-year track record. And you could discuss it with your person at a bank and see if they would also recommend that, and maybe start a small systematic investment every month into that kind of a scheme. So like all of us earn every month, we spend every month, we save every month. So why not invest every month? So make a small beginning in that way. And as you gain confidence, you can, seek multiple sources from where you can get more information, more advice, and start in a bigger way.
But, Rita, I'd like you to first focus on why we need to make our money grow. Women are excellent savers. We all know how to stash our cash. Any extra amount, any time of need, we all have a little kitty of our own. But I think what's important that women need to realize, money is not money kept in a bank or your savings account. You need to realize how to make your money grow and then treat yourself.
Right. So, why do we invest our money? I think you would like to invest our money because right now you're earning. In future, you will retire. So you need to grow your money to meet up with your, the first and foremost is what are my requirements in next 10 years time frame, and I should actually plan my cash flow. I mean, investment comes later. First is, what is my cash flow requirement? Based on that only we should, start investing the money. So the investments are when, you are not able to earn because, we all, as you grow and you mature, you feel you have a limited, life in which you can earn the money. So idea is to ensure that we grow the money and we meet the cash flow objectives of a person, and then only the investment thesis and investments come up.
Not just that, Hina, I feel why should just money sit pretty in your bank account or the cash that you've stashed out? The need and the emphasis to make your money grow with that excess amount, deploy that money further. The power of compounding, I think, is what we need to, how can you make a 3 lakhs into, say, a 30 lakhs in 10 years?
Okay, so here is a goal for all of you today. You all have to reach that stage where your money is making money and you're working for the pleasure of it. Okay, and you've got to start early. Let me give you some statistics. If your household spend today 6 lakhs, 20 years hence at a 7.5% inflation, which is not that far-fetched for a growing economy like ours, you will need 25 lakhs, all right? So there is compounding happening on your expenses. You have to make sure that the compounding on your investments happens at a faster rate.
Okay, we have lots of questions here, but I'm going to take a very quick break and be right back with the Q&A with our esteemed panelists. Any questions from the audience here? Yes, go ahead, ma'am.
Are there any mutual funds that help us to plan for retirement and provide protection?
Retirement, really what anybody wants at the end when you are retiring is a nest egg that you should have built over a period of time, which should be able to take care of your expenses and maintain the lifestyle that you today have. So that's really what you're looking for. And while mutual funds may not provide you a retirement, there are retirement solution schemes, but mutual funds is a vehicle through which you can invest in various asset classes. You could build your own nest egg. So you invest over a period of time into various asset classes, and like Hina just mentioned in terms of how the compounding effect that investment can have. So you build your nest egg and then keep withdrawing from that, and that's how you can plan really in terms of your retirement solution without really having a pension that is coming to you. So there are 2 ways that you can do it. There are pension schemes, there are retirement benefit solution schemes where you can invest and post a certain period you start getting a return from that, or you can just build a nest egg through equities, through bonds and of mutual funds, and build a nest egg which gives you a certain return on a periodic basis the way that you would like it.
How do you find a reliable fund manager?
When you're interacting with an investment advisor, it is not just their qualifications and experience and various certifications. It is also that that person should have the maturity to put herself or himself in your shoes and look at things from your point of view. So everybody has a different risk profile. and where you invest, whether anybody can create a financial plan for you. But ultimately, will you end up sticking with that financial plan for the rest of your life is a function of whether your own inherent risk profile was taken into account when that financial plan was made. Because, initially that advisor may themselves impose their own risk profile on you. And that happens. They may be aggressive, you may be conservative, but he may put maybe 80% of your money into equities. So when markets fall, at the slightest whiff of, some volatility, you may get panicky and you will pull out, which is not the right thing to do. So it is very important that that person is able to be in sync with your sensibilities. And once you get that comfort with someone, then you know, okay, I can trust this person. He's thinking in my interest. For that advisor, your interest should be of paramount importance.
So I think first we need to, sort of figure out how much money, where do we want to see it. And Rita, let me, come to you on this one. Let's start with the ground basics. I have 10 lakhs or 1 crore. How do I go about allocating how much in gold, how much in real estate, portfolio allocation? Do I take concentrated bets in mutual fund? Because right now, real estate is not doing good. Gold is crashing. So do I take concentrated bets, put all my money into mutual fund? How do you make that decision?
Sure. So I think the first is suppose this 10 lakh rupees which you have, you need to first decide when will you need this money. So you need to divide your total portfolio into short term, long term, and what we call a core portfolio, which you will never touch, basically, which is your reserve fund for emergencies, etc. So the short term requirement of the funds, you should always invest where you can easily take out the money at a short notice of let's say 1 day or 2 days, because it is very difficult for us to predict the emergencies which can come in anyone's life. So the short term should be invested in totally liquid funds. Then you should go into the long term thing, and my view is that we should always look into what is my core portfolio. So normally you take 20% of your money which you feel you will never require. Those you invest into long term. Short term, always there are liquidity risk and there are liquidity factors which always lower down your returns. Whereas in long term, I will always give you higher accrual, compounding factor, etc. So idea is, divide your thoughts or your cash flow requirements into short term, long term, and core, and then decide your investment allocation.
Let me start off with you, Ritu. The short term money, accidents, someone falls ill in the family, that's the emergency fund. How do I go about planning this 20% emergency short-term requirement fund?
Okay, so the short term could really be exceedingly near term,
yes,
to probably about a year and a half. There is opportunities, or there are options available in the mutual fund space which can help you deploy monies where you want, where your short term could mean as little as a week, a month, to as much as about a year and a half. What you have all along traditionally been doing is having savings banks account and probably doing fixed deposits for slightly longer term than the savings bank account. So you have mutual funds which give you those alternatives, which are akin to a savings account and akin to fixed deposits. So that's how you would spread your, that 20%, which is for the near-term goal, between money market liquid funds and short-term bond funds, as they're called.
Ritu, also tell them why a mutual fund and why not, fixed income.
The one thing that the mutual fund gives you, which is of paramount importance and which is something that any other instrument or any one particular bond will not give you, is the diversification that a mutual fund provides. So the money that you put into the mutual fund goes and gets invested into a portfolio which is 50, 60, 70 bonds. So my question to you really would be that why would you invest in one bond or one fixed deposit scheme or one corporate when through the mutual fund route you can invest and get a portfolio of 50 bonds? Why wouldn't you want to mitigate your risk?
Fair point.
And in addition, mutual funds are more tax efficient. So on a post-tax basis, even if your gross returns on a fixed deposit and a mutual fund are similar, a debt mutual fund are similar, you may end up having a higher net return in your portfolio through the mutual fund route. And they're very simple to kind of invest in, and they are very liquid too. So in a liquid fund, your funds are available the next day. So that shorter notice, the funds are available at.
So it's as good as drawing from your regular bank account, right? Yes, go ahead. Someone had a question.
So when you say in the liquid fund, in the mutual fund, you have that scheme, so will it be that your interest rate will come down if you withdraw the money at a short notice?
No, not at all. You earn a return on a daily basis, so you do not lose. It is not like an FD where you break it. Every day you earn little by little. So till the day you are invested, you are earning. You do not lose anything at all.
Yes, someone else had a question.
You know, you were talking about investments and how we should allocate them. So do you have like a mantra which you can give us? Say at the age of 30 what you should be doing, at the age of 50 what you should be doing, if you're starting from scratch?
Actually, there is no single solution for someone, everybody who's in the age group of 30. No, it's not like that. It depends on each one's personal circumstances and what are they looking at, what their goals are in life. Yeah. So the first thing when actually you sit with a financial advisor is that we try to take a holistic view of your entire financial situation. Where are your current investments? Are they all in savings account? Or partly it is in real estate or gold or fixed deposits? So that information is necessary. What are your goals? So each one's goals could be different. So we need to prioritize that what are the most critical and important goals to meet. Once you know that what are my goals, we also look at your risk profile that, okay, to meet these goals, and this is your kitty which you have, these are the earnings which you will, bring over the years. So what is it which is available in terms of inflows and what the outflows are going to be? So once we have that and once we know your risk profile, then we try to create an investment plan for you. So sticking to a financial plan is important, and that is where I think the most critical part of an advisor comes in, that he makes sure that you are following this plan in a disciplined way. And during times of volatility in various asset classes, they are able to handhold you through it. That is very, very important.
Yes, ma'am, here, your next question. Yes.
One figures out from this discussion today is that you need a certified, experienced investment planner for you. Now, how does one find about such a person and the person who can grow? Say, if I have never invested into mutual fund and I want to do it slowly, so how does one know about it?
Look out for a financial advisor who owns the company, who is an independent person. That person cannot run away, okay? And they are very conscious about where their brands, right? So you might want to interact with somebody with whom the buck stops, okay? Secondly, there are financial planners who charge you, okay? Instead of charging, instead of getting a fee from the mutual fund, okay? That is more in your control. So they are then motivated to perform for you. So look out for those financial planners.
Okay, we're going to take a very quick break on that note, but we are going to come right back, take a whole host of viewer queries as well with our panelists sitting right here at UTI Mutual Fund presents Swatantra. Okay, now, yes, you have a question.
So I was wanting to know that insurance, besides providing a good life cover, so is it a good investment plan also for future, like say investing for kids education? So something, if you're looking 10 years down the line, so does insurance provide a good investment opportunity also?
The thing is, there is no wrong or right answer. You could either make an investment plan for this bucket, for this requirement, and it could be a mix of various asset classes. So if the lead time is 10 years, you could still do a mix of equity funds and debt funds through the mutual fund route, and a financial advisor can guide you towards it. But here the important thing would be that this is a bucket where the requirement is 10 years from now. So you need to continuously invest into it, build this corpus, maybe closer to the 10th year. Maybe 2-3 years prior to that, you start reducing your equity exposure there. But you need to be disciplined about it, that this money you are not going to touch for anything else. In terms of insurance offering, where they say a child care plan, It is more of a packaged product. They market it like that. Underlying still remains the same. They will still do a mix of debt funds, mutual funds, and give you a life cover.
What should be the proportion if I am looking at investing in mutual funds, short term and long term, as well as insurance, which gives benefits post a certain investment period?
Insurance and investments are two completely different things. So, it's very difficult to say that this X percentage should go into insurance and X percentage should go into investments. Insurance is not really an investment vehicle. Insurance is a protection vehicle. So, only as much should go into insurance, as much as protection that you need in terms of what you want to leave behind just in case there is something that happens to you. For investments, purely because of the flexibility that it offers, that mutual funds offer, you should look at an insurance product for the protection need, and you should look at mutual fund products for investment needs.
I just want to know the risk factor mutual funds vis-a-vis fixed deposits.
There are a lot of mutual fund schemes which are available to you, which are actually an alternative to fixed deposits. It does exactly the same thing that a fixed deposit is doing. It's doing exactly the same thing in the sense that you're lending to the bank and the bank is lending further. You're giving money, investing into the units of mutual funds, and those mutual funds are lending out or buying bonds of various companies. So, so that's one type of mutual fund. But typically when you understand mutual funds, you think about it as equity market investment because you look at, so mutual fund is really a vehicle which invests in gold, it invests in short-term bonds, long-term bonds, and equity funds. So equity is just one kind of mutual fund. There is So fixed deposit cannot be compared to the equity mutual fund, if that's what you always thought of mutual funds. Yes, but the fixed deposits is very comparable to bond funds, which give you a certain, because the way the bank makes money and therefore gives you money is essentially the interest that it's earning on its investments, which is the bonds that it has lent out to. Similarly, the mutual fund also debt-based mutual funds. These are debt-based mutual funds, which are very similar to fixed deposits. In fact, better than fixed deposits because of the tax efficiency that they have. That's built into the product.
Yes, you have a question.
I just wanted to know how is FMP as a asset option, as an investment option?
So fixed maturity plans are a debt part of the mutual fund. So what they do is they invest for a fixed duration. So FMPs are good for people who if they know that the money, they will not take out the money in between, because otherwise there are exit loads in the fixed maturity plans. So if you're certain you don't need this money for 3 years, you lock in, what is called a lock-in, you lock in the money for 3 years and you earn a defined rate of return.
No, actually, nowadays you can't even take out money from FMPs. So you're essentially locked in for 3 years, and with the change in the tax rules, now FMPs make sense only from a 3-year perspective. So if you're very certain that you will not need your funds for the next 3 years, whatever the emergency may be, then you may park there, and they are kind of, they replicate what an FD does for you. They kind of give you a fairly certain return. You know in advance what you're going to get.
Yes, ma'am, go ahead.
Pertaining to children's education, like it was asked earlier, but what happens if an entire family, as a family unit, decides to put in X amount of money? If you're an individual, you can be disciplined or not disciplined about the savings. But if the family unit decides to put in as much as maybe 50 to 20% of their earnings into the education of the children of the family, which could be a growing family, so it could be 20 years or 30 years hence. But the most compelling thing is to secure a good education for your children.
True.
So is there any instrument where, because if it goes into a fund, then somebody needs to manage it, and it has to keep on being managed by somebody.
Hina, I'd like you to take that. Children's education, how do you go about planning for that?
The way I think you should go about this is that if your children are young still and you have a time horizon of 8 years and beyond, okay, then pick up a good diversified equity fund, all right, which will grow, compound, and will tend to beat inflation. But let's say if there is a child within your framework who needs to go and pay the fee in the next 2 years, then I would not take a risk with equity at that point in time. I would go in for a debt fund. Okay, debt fund will give you a lesser return, may or may not beat inflation. Most likely right now it's beating inflation, but there'll be a certainty of the amount that you will get.
So we could go on and on taking questions. I know all of you all still have questions, but I'm just going to wrap up by first thanking Vicky for giving us this lovely venue this afternoon and meeting all of you bright women out here. And all I want to say is that, treat yourself, and treat yourself by treating your money right. There's immense potential, which is not going to, come out by money just sitting in your bank. So I hope this was an enlightening discussion for me as well. And yeah, it's never too late. Start now. And thank you all so much.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents